We want to start our discussion today where we left off last time. We're talking about basically reasons that we have banks, functions performed by banks. And what we talked about is that in these situations where we have a saver and a borrower, or I should say savers and borrowers, that direct transactions between these two groups have problems with them. And these two problems basically come down to there's asymmetrical information, unequal information held by these two parties. Savers just don't have the information borrowers do, and so when this money is handed over, there are very high risks of the savers not being repaid. And I grouped all of those problems, those risks, into two different categories last time. The first one were the types of risks, the asymmetric information that exists at the time the loan is made, and we call those adverse selection, or I should say risks that occur because of adverse selection. Adverse selection means, hey, because of the way these markets would work out, we would end up adversely selecting only the worst borrowers. We would only be making bad loans. You remember why that was? We set a price for loans and interest rate for loans. And then the people who are the safest borrowers just go away. They say, that's too high. And they go away, and so all that's left is bad borrowers. We are adversely selecting borrowers in that process. Okay? And then after a loan is made, we have a problem called moral hazard. And moral hazard results in high losses on loans. Moral hazard refers to the fact that after a loan has been made, the borrowers start behaving irresponsibly. Hey, I'm playing with your money, and so any negative consequences of whatever I do fall on you. And so now I behave less responsibly, the borrower does, than if the borrower were using his or her own money. And so anyway, and the saver says, boy, I wish you'd treat this like it's your own. I wish you'd be really careful. And the borrower goes, why would I do that? If there's a loss, it falls on you. I can't pay you back. Sorry. So anyway, at the time of the loan and after the loan is made, there are these things, these problems due to asymmetric information that makes it unlikely that the borrower will pay the saver back. And so that means that savers will just go, I don't want to have any part of this. I'm just not going to lend my money out. And so then when savers say, I don't want any part of it, I'm going to lend my money out, then what that means is loans aren't being made. And I don't want to go down this path, but the same problems exist in the stock market and the bond market. And so as soon as these people, these savers just say, I don't want any part of it, and then they go away, then there are a lot of activities over here. There are people who want to send their kids to college. There are people who want to own cars. There are people who want to own homes. There are businesses that want to hire people and build factories and stuff like that. And those borrowers just can't get money. Credit, I should say. Funds, financing. And so there are a lot of desirable activities that just don't occur when this relationship breaks down. And it breaks down because of asymmetric information. So anyway, we discussed all that, laid the groundwork. This time what we want to talk about is this. How do we solve this? Now I gave these practical examples last time of the lemons with the cars. And the way we addressed that problem, that's the adverse selection, was Carfax, and we have experts look at our cars, and we only buy a car from somebody who will give us a warranty. And the moral hazard problem, we gave the practical example of the insurance. Once somebody starts insuring your behavior, then there's a tendency to start behaving irresponsibly. Well, that means the insurance companies have to do something about that, and they do things like raise your rates if you have claims, or cancel your policy if you have claims, and so forth. And so there are ways of coping with these problems. In financial markets, there are ways of coping with the problems, and that gives rise to a whole bunch of institutions and regulations. We have regulations in the stock market, Securities and Exchange Commission. We have specialists in the stock market that called investment bankers that we don't really want to get into. But there are ways of coping with those problems in stock markets. We have in the bond markets, we have these ratings by Moody's and Standard & Poor's. In the loan market, which is the part of the finance market that we want to talk about, in the loan market, these techniques or these ways of coping with adverse selection and moral hazard come down to banks. So what we're saying is this. The reason we have banks is to cope with this problem that people can't cope with on their own. If people just had all the information in the world and all the skills to handle these problems, then the need for banks would more or less go away. But we don't have those skills, those abilities, that information. Okay, so how do banks cope with these problems? First of all, and again, we're going to talk about banks next, but the key thing, I believe I mentioned this last time, the key thing that banks do is they make loans. Now they accept deposits, but then they make loans. I think I told you last time, something on the order of 60% of all the dollars flowing into banks, and vast amounts of money flow into banks, 60% of that becomes a loan. And so that's the main thing bankers do with their money. And so that is really what we're talking about here, is this loan situation. How do banks cope with adverse selection? Meaning, how do they avoid making loans to people that aren't going to pay back, that somehow or another we don't think they're going to pay us back? Okay? And they begin by gathering detailed information. Okay? And you might say, oh, anybody could gather detailed information. You know, you could sit around asking questions, but it's not just a matter of asking questions, but there's also thinking, oh, gee, how could I be misled? What kind of documentation do I need? And there is information that you need some expertise in order to gain access to this. And so they're gathering detailed information about borrowers and their plans. And don't forget, it's not only people that are borrowing money from banks, but also companies. Okay, so we want to know things about these borrowers and their plans. And we want to know about their income, net income. We want to know about their assets. We want to know about their business activities. We want to know about how they're spending their money. All these things play a role in whether somebody's going to be able to pay a loan off or not. Okay? In the case of a business, if you go to the bank, you're managing a business, you go to the bank, you apply for a loan, they don't just say, gosh, you know, you've been in business selling, I don't know, fish hooks for many, many years. They start saying, what are you going to do with this money? And you tell them, oh, I'm going to build this or that, or I'm going to acquire some asset. And then they say, why don't you bring us in a business plan? Just show us what your plans are for the next 3 years or whatever it is with this new business you're going to build or this expanded business. Show us your business plan. And then you come in with a business plan and it just looks like something you've written down on the back of a 3x5 card in 5 minutes. And they just go, it looks to us like you're not going to pay us back. Denied. And so you spend some time making up one of these business plans. How many of you have had a course over in the College of Business where you've worked on a business plan? Anybody? You have? Just one guy? Okay, you're going to have to do that. But that is the point, is that, you've got a business plan. You've got a little story here with some numbers, but it's like, here's what I intend to do. Here's what I'm going to do in the first month, and the second month, and the third month. Here are assets I'm going to acquire. Here are people I'm going to employ. Here is an advertising technique that I'm going to use. Here's a technology. Here's how this is going to develop over the years. Here are new milestones that I think I'm going to meet over the next 6 months and year and 2 years down the road. A lot of things that go into that. And then they say, hey, you've thought your way through this. And that's really what you're doing with a business plan, is you're telling the lender, or it could be an investor, but you're telling them, I've thought my way through this. This is not just something where I'm rolling the dice and hoping things work out. I've really got this all planned out. I know who I'm going to hire. I know what technology I'm going to use. Okay, so after they acquire all this detailed information, then what bankers will do is they'll screen that information. Meaning, what's this screening process? That really just means they will analyze it. What's this all add up to? What does this mean to us? And the screening means that this information comes to them, and then they'll say, no, no, yes. And they're screening out the bad applications by analyzing all this information and possibly other information they have available and trying to make some prediction about the future. Is this person going to pay us back? And so this analysis takes a lot of time and effort, you know, let's just say you sit down here at the desk and you just say, hey, I'm going to lend some money out. And, you know, we started off with the saver doing this. A person who's pretty clever, who's kind of experienced, could come to you and trick you pretty easily. They might go, oh, you know, I've got the greatest idea in the world. And they could tell you a story that you might say, yeah, okay, yeah, I see what you mean. And after a while, you're handing some money over. And then after a while, that person's moved to another country and they're living the high life on your money and you never see them again. And so somebody with experience and insight is going to have to analyze this story you're telling to see does this make sense? Does it hold water? And sometimes it does, sometimes it doesn't. What happens in a bank is somebody gets a job. The entry level in banking is very often teller jobs. But other than a teller job, the other entry level type job is a loan officer. And what they'll do is they'll sit you down at a desk, and you've of course taken some courses and learned a little bit about this, but they'll set you down there and they'll give you authority to loan up to a certain amount, not very much. And then if somebody comes in and applies for a loan and they want $10,000, maybe from your book learning and your education, you can make that loan or make a decision on that loan. But if you want to go above some threshold, $10,000 or $20,000, you have to get your boss involved. And your boss comes over and looks at your analysis. And it says, hey, here's something you've overlooked. This is not going to work, or this is something that you should have asked that question or obtained this information. And then if the loan is over $100,000, let's say, then your boss can't sign off on it. You have to go to somebody with yet more information, or more experience, I should say, in the banking industry who's been making loans. So there's a lot of experience that is required in order to analyze these applications. Because as I said before, anybody can lend money. It's getting it back that is the challenge. And the way this is really important up front is figuring out, is this person going to pay me back? Can I predict, can I look down the road and see what could go wrong, what's most likely to go wrong, what's likely to go right? Another thing that bankers do, which reduce this adverse selection, is they establish long-term relationships. With the borrowers. You know, if you are lending your own money out, you as an individual, I don't know, a person who's saving for retirement might have $100,000, $200,000, $300,000, maybe multiple times that amount, $200,000, $300,000, $400,000, $500,000 that they've saved for retirement. But you know, that's not a vast amount of money when you start lending. Most people, if they're going to save $500,000, they don't have that $500,000 till the day they are ready to retire. And earlier in your life, when you are 35 years old and you have a little bit of money to lend out, you're not really in a position to establish a longer-term relationship with these borrowers. Maybe the first borrower that comes along wants everything you have. And so how are you going to establish long-term relationships with a large number of borrowers? Well, that's not a problem for banks, because banks will set up in your hometown, and there'll be businesses in your hometown that have been around and conducting their business for 10, 20, 30 years, and they keep going back to that same bank to get loans. And that banker has learned over the years about the nature of that business, what the problems are, what things can go right about it. But these longer-term relationships get developed, and then it's far easier for the banker to say, hey, this is a good idea or that's a bad idea. Okay? And so that is something that will happen with bankers is customers, especially business customers, but frequently just individual borrowers too, will go back to the same banks over and over and over. And then as time passes, the banker has a lot more insight about whether that borrower is going to pay the loan off. Okay. One thing that happens in these longer-term relationships, and this is really for businesses, is there will be a line of credit. A line of credit is basically a pre-approved loan. And I'm going to work this back to the long-term relationship here in a second. What will frequently happen, let's say that you've got a business, a small business or a medium-sized business, and you go to a banker, what you might say is something like this: you know, I'm not ready to do it right now, but sometime over the next 6 months or a year, I kind of think that I'm going to go out and, I don't know, build onto the restaurant, or let's say remodel the restaurant, you know, the kitchen or something like this, or buy a new delivery truck or some large expenditure. I don't know exactly when, and you know what? Maybe it won't happen this year. Maybe it'll be next year. But when the time's right, I'm going to do this. And so then you might go to your banker and say something like, I'd like you to kind of set something up where we kind of reach agreement, and we'll sign a piece of paper and so forth, where that if we get to that point, you promise to loan me that money. Because I don't want to go out and hire an architect or negotiate a deal and then find out I can't get the money. How about let's just work things out right now between us? And the banker says, okay. And they will then, after looking at all the details, they'll pretend it's going to be a loan and go through all the process of extending the loan and then just not give you the money. And then you have a line of credit. And they might say something like this in the line of credit: we will, at your discretion, lend you $200,000. And any old time you want, you can just go out and negotiate for that delivery truck or add on to your restaurant or whatever it is you feel like you need to do. Up to $200,000, just write a check. And when the check comes back, we'll honor it. That will become a loan on that day. Now, by the way, this sounds like a credit card, right? And it is a credit card. It is no piece of plastic, but it is a pre-approved loan that businesses arrange for usually fairly large amounts with their bankers. Now, here's what that does. That relationship right there ties that borrower, that business, to that banker in a long-term relationship. Because now, I've already made plans for a loan 6 months or a year or 2 years down the road. I'm going to still do business with that bank over this longer period of time. And this line of credit is something that does tie them together. And that bank makes the banker feel more comfortable about their relationship. Okay? Another thing that bankers do to reduce these adverse selection problems is they require collateral. Now, collateral is an asset. And it's an asset that you pledge, if you're the borrower, you pledge that asset and say, if I don't pay you, then you can take this away from me, this asset, and sell it and get the money I owe you. And there is a way of reducing the likelihood going into it that the loan's going to be bad. Well, if it is bad, then I still get my money. Okay? A lot of times, not so much with businesses, but a lot of times for individuals, when we go get a home loan or a car loan, those would be the biggest loans, then the asset itself is the collateral. And so what would happen is this. Let's say you're buying a house that's a $100,000 home. I'll just put $100,000. Then what they would do is the banker might say something like this: I want you to put $20,000 as a down payment, and then I will loan you $80,000. Okay? And for the banker, this down payment is a key, because then what we'll do is this. You go out, you buy the house, there'll be a deed, which is basically a title. We'd say title for a car, but there'll be a deed to that house, and it'll have your name on it. And that'll be filed downtown that says, you own that house, except that banker's name will also be on that deed. Let's say you and the banker. It doesn't really say the banker owns it. It says this: you cannot sell that home, transfer ownership to it, to the home, to somebody else, unless the banker signs off on it. So, then what you do is you say to the banker, hey, I promise I'll make these monthly payments. And if I don't, you can come take this house away from me and sell it. And the banker says, hey, if I take this $100,000 house away from you and sell it, I bet I can get my money back. Now, if this is only a $5,000 down payment and a $95,000 loan, I don't know, maybe I can't seize that house and sell it and get $95,000. And so the bigger this down payment, the safer the loan is for the banker. And a traditional down payment would be 20%. This is traditional. That doesn't mean it always is. And there have been, over the last decade, there have been a lot of banks get in trouble by requiring 5% or even 0% down payment. If somebody says, oh, no down payment, I'll loan you $100,000, then what they're saying is this: if you get behind on those monthly payments, I'll take that house away from you and I'll sell it and get my $100,000 back. Really? Well, that's not what experience shows. Because usually when people get behind on their house, they stop painting it and fixing the plumbing, right? Taking the trash out, doing all those things. And then very often they kind of skedaddle out of town. And then we don't even find out there's a problem until, the rats are living there and stuff like that. The roof's leaky. So what I'm saying is the people who do not make those payments and lose their homes, frequently when we take their home and sell it, we cannot get the purchase price out of it. So what that means is when bankers are making small down payment or requiring small down payments, bankers very often, if the loan goes bad, bankers are going to lose something on that deal. Maybe they sell that house for only, $90,000 and they lost $10,000. And that is the reason for a down payment, is to reduce the banker's risk. Okay, same deal on the car. But what I'm saying to you, and I guess the example I'm giving is for individuals, usually it'll be the house that stands for collateral on the home loan. If you go out and buy, let's say, a $25,000 car, then they might say something to you like, hey, we want you to put, let's say 25%, that's a hard number. Let's say 10%, 20% down. I'm looking for a number I can work with, down payment. And so we'll loan you $20,000. Is that 20%? Yeah. And so anyway, and then here's the loan. And if you miss the payments, they come out and take the car away from you, sell the car, and hope they can recover $20,000 from selling that car. Okay. Now, it's not always this way with businesses. Businesses have quite a few other assets. Like if you've been out here operating a business, let's say that you've got a mail order company and you're selling things by mail and online and things like that. You've got some assets. It might be that you own a warehouse. It might be that you have some inventory in this warehouse, and it might be that you've got receivables where people owe you money and you're going to be collecting this at the end of the month or within 90 days, and you might have a lot of assets. And so you might go down and say, I want to borrow some money, and then I'll pledge one of these other assets as collateral for the loan. Okay, so very often the collateral is not the item, the asset that is being purchased when we're talking about a business. But one way or another, the key here to our story is that if we require collateral, then what we do is we reduce the likelihood that we're going to get into a loan situation where we can't collect, okay, or where we lose. And bankers are better at doing that than other people. Somebody could come along, let's just say you're doing your own lending. And somebody comes to you and says, hey, I want to borrow some money. Maybe you've got vast amounts of money. And somebody says, hey, I want to borrow $100,000 from you to buy a house. And you say, you want to buy a house? Well, I had money in banking class, and I happen to know, you might be thinking this, not telling them, I happen to know that I better require some collateral here. So you say, I'll tell you what I'm going to do. What'd you say that house is worth? $100,000. Tell you what I'm going to do. I'll loan you $80,000. And we'll put my name on the deed. This is the saver who's doing the lending. We'll put my name on the deed so you cannot transfer this without getting my say-so, my approval. And they say, okay, that sounds reasonable. And so then you make the loan to somebody, and they have put down $20,000, and you loan them $80,000. And everything looks okay. Here's what you didn't know. They've got a friend who's an appraiser of property, and the friend appraised this property and said, it's worth $100,000. But really, it's only an $80,000 house. But they've got the official appraisal. Here it is. And you say, yep, there's an official appraisal. It's from the ABC appraisal company. It says it's a $100,000 house. You put up $80,000, or $20,000, I'll lend you 80. You lend them 80, you've really made a 100% loan. They didn't really put anything down. Why? Because they control this appraisal process. Now, couldn't you figure this out? Well, possibly, but how much contact do you have with appraisers? This banker's making loans daily. You're making one loan every 5 years or 10 years or something like this. You don't know the appraisers like like a banker does. You haven't had an opportunity to find out which appraisers are accurate and which ones are not. And so it's easy for you to lose your money. So I'm just saying to you that there are things that bankers can do, and they reduce the problem going into it that most people would not be able to deal with. Now, what about moral hazard? How do banks deal with that? What do the bankers do after the loan's made? How do they make sure they don't lose at that point? First of all, what they'll do is they'll monitor these payments that are coming in. And they'll monitor those closely. What will happen is there'll be a loan officer. They'll be sitting there. Here's a list that they'll see every morning when they come to work. And right there on their computer monitor, there's a list of loans that they've got outstanding. And then boom, 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 it's flashing. Hey, here's a loan that's overdue. They didn't make that payment. They don't have anything to do but just come into work and, of course, eat some donuts. But they don't have anything to do with that. You get up in the morning, you go to work, right? You've got to, take your dog to the vet. You've got to take the kid to school. Your boss is sending you on assignment. You've got a lot going on in your life. A loan officer comes in, sits down, eats a donut, and there's this flashing deal. Late. What do? They get on the phone and call you. They got nothing to do with that. So they're monitoring this pretty closely, and I mean a large number of loans. So this constant monitoring, there's something else they do. They monitor compliance with collateral agreements. We talked about collateral a moment ago. You pledge some asset. Guess what bankers do? Bankers are looking, and I don't mean to say every banker all the time. I'm saying this is a function of loan officers and their department. They are paying close attention to find out if you're trying to transfer assets that they think they got their name on and that they got basically a claim on. But they're watching down there. Are you filing some new deed that takes their name off of this asset? And they're paying attention to these things. I was in a bank one time and talking to, actually that's not the right word, begging a loan officer for a loan. I was down on one knee, so that does qualify as begging. Anyway, and I was not proposing that I get a loan, I guess. Anyway, so I was there, and the phone rings, and so the loan officer says, hello. Well, it's a car dealership, used cars. And the car dealership was calling up to make an appointment with this loan officer saying, could you come over Tuesday, at 10 o'clock or whatever time of the day? A loan officer had made a loan to the car dealership. The car's sitting out on the showroom floor, out in the lot and so forth. We're collateral. And the loan officer had these periodic visits over to the car dealership with a list of, okay, where's that, 1994 Buick or whatever. I want to see it. It says right here that you've got one, now show me. So these loan officers, you don't just say, I pledge, and then them go, okay, I take your word for it. They are keeping up with this. And if there's something goes wrong down the road, they find out about it fast. And then that's when they start going, hey, we had this deal where we loaned you that money and you signed your name at the bottom of the page. And then, you remember all that? Yeah. Well, you know what? You broke your end of the deal. So why don't you just pay us off and we'll go our own ways? First time I bought a house, I won't go into all the details. First time I bought a house, I paid for it on a Saturday. That was my mistake. The realtor is acting as an agent in this deal, says, I will take this money down on Monday and pay off the previous lender of this house. And so Monday, title will be transferred. It wasn't transferred that day. I gave the check that day, but title wasn't transferred that day. Monday, I'll go down and do this. I said, okay, that's fine. So then, I go down on, I don't know, Tuesday, and I filed a deed in my name. I now own that house. And then I went about my business. And that house needed some remodeling. I hired some people. They were in there. They were working on it. And I don't know, 6 weeks later, something like that, phone rings. Hello. And it was a guy with a savings and loan. He was a nice man, as it turned out, a lifesaver. He said, hey, I had somebody down at the recorder's office, recorder of the deeds. I had somebody down at the recorder's office going through the records, and I see that you filed a deed on such and such a house, you know, an address. And I said, yeah, I bought that house. He said, well, you can't really buy that house because I still have, our bank still has its name on the title, on the deed. And I'm going, what does that mean? Because I didn't know what that meant. I had enough money to buy a house, but I didn't have enough sense to avoid losing all that money. And what had happened was this realtor who was going to go down on Monday and pay that house off, what I found out later was he was speculating in the real estate market. And so when I gave him this cashier's check, he cashed it. He didn't put it into an escrow account and he didn't pay off that loan. He took that money and bought some property because the price is going to go up and he's going to get rich, he thought. And then something happened was he wasn't able to sell that property. And since he couldn't sell the property, he didn't have my money back. And since he didn't have my money back, he didn't go down and pay off that other home. And since he didn't pay off that other home, that previous lender still had their name on the deed. And that meant my name couldn't be on the deed. So when I filed as owner of this property, alarms go off. He calls me up. He goes, you don't own that property. You just paid for it. Huh. Now, he has to explain this to me like 3 times because I couldn't breathe. I said, that means, what does that mean? Well, it means that you paid that money and you have no house. Turned into a very lengthy thing, and it really was lengthy, and it took maybe 2 months to get this resolved. And during that period, you would be surprised at how many times I would wake up in the morning like at 4:30 and go in and sit in the kitchen and just put my head here and go, oh, what am I going to do? I finally got in touch with, there's a real estate board, and this was a realtor that did this, all this stuff to me. But anyway, there's a real estate board in the Capitol. And there are 3 people that sat on that board, and each one of them is from a different part of the state. And I talked to one guy that was on that board, and he represented this part of the state. And so I explained it, and he said, oh, just a second. That is not going to happen in my district. And he said, you're talking to the right guy. I'm going to handle this. And so he did handle it. And then just a few days later, that money was transferred over. The previous lender was paid off. And then the deed that I had filed did get transferred over into my name. This is what happens when we do our own stuff. And so, anyway, I did get the house. The funny part of the story is this. The guy who did that, and I won't mention his name here, but the guy who did that was pretty well known in town, and he had this real estate agency. He was his name on the agency. And he was, I don't know, pretty close to retirement age, very heavy, about 300 pounds, and was not in good health. And one of the things that this fellow told me that called me up, the one who said, hey, I still have my name on that deed. You can't own it, or our institution does. He said, don't go over and get this guy and like pressure him too much, because all he has to do is fall to the ground and clutch his chest and say, oh, you caused me to have a heart attack. I'm going to sue you, because he said, this guy is in money troubles. He's having money problems right now, and he's looking for a way out. And so he said, don't go confront him. I said, okay. That's a hard thing not to do, by the way. So I didn't go confront him. And so I went through this whole experience. Finally, it's all paid off. And then like 3 years later, I was over here on a Saturday afternoon, I was getting lunch at some little sandwich shop up the street. And it was in August. This is, like I say, 2, 3, even 4 years later, several years later. And it was in August, and it was one of those days where it's 100 degrees out, and the sweat's just pouring off, and So anyway, I drove up to this sandwich shop, and I got out, and here comes this guy, this 300-pound guy who had tried to cheat me out of all this money. He came out of the sandwich shop, and he's walking along, and I look at him, and I think, who is that guy? And it's like a familiar face, and I say hi, and he says, oh, hi to me, and then he goes on, and I go on in, and by the time I'm standing there ordering my sandwich, I know who this guy is. And so I think, don't even, don't turn around. So I go ahead and I get my sandwich, and I got it to go, so I'm walking out to my car, and this guy's out there, and he's in his car, and he's trying to get it started, and it just will not start. And it's just turning over, and then the battery's going dead. And so I got in my car, and I'm just thinking, hey, don't be having a problem here. So I get in my car, and I've got the air conditioning on, of course. And so I push a button, and the window goes down. And I said, hey, buddy, you having trouble? Now, here's this guy, it's 300 pounds. It's 100 degrees, and the sweat is just rolling off of him, and he's doing all this kind of stuff. I said, hey, buddy, you having trouble? You need some help? And he said, yeah, thanks a lot. And I said, that is a damn shame. And I put it in reverse, backed up, and just drove on down the street. Anyway, that's the kind of guy I am. And so I had my own little laugh, after all of a sudden. I learned a valuable lesson from that, a really valuable lesson. And that's what I'm telling you is, if you start doing your own business, there's always somebody over there that's smarter than you, more experienced, maybe not smarter IQ-wise, but got the experience to take advantage of you. And that's why this doesn't work out. This direct finance is what it would be called, where we directly handle these investments. It's a difficult thing to do. And so lenders, people that have been lending hundreds and hundreds and hundreds of loans over the last 3 years, just seen it all, and they are not so easy to take advantage of. They monitor spending. Now, not so much for you or me, but here's what happens if you've got a small business and you go in and you get a loan. Guess what that lender will say to you? Oh, so your restaurant, you want a loan. That's real good. We want you to keep your checking account here. And you say, okay, I don't care. They might say something to you like this: no service charge. You keep your checking account here. You say, okay, that's no problem. You keep your checking account there. Guess what the banker's doing? They're monitoring every deposit you make. They're monitoring every check you write. And that doesn't mean they care who you're writing the checks to. They want to know if there's more being put in on a monthly basis than is going out on a monthly basis. Because if you have month after month after month where, let's say, 10,000 is going in, 11,000 is going out, there will be a day when there's no money there to make that payment. And the banker wants to know that in advance. And so they can monitor your spending behavior by basically having you keep your checking account there. Okay? One thing that bankers do that, and it's not really moral hazard so much, is to minimize costs. That is, what we've been talking about up to now is, how can I avoid making bad loans in the first place, adverse selection? How can I avoid loans going bad, moral hazard? Well, we still recognize that a certain percent of loans are going to go bad. So how can I make it where when a loan does go bad, it's not going to put me out of business? And they minimize their costs, I should say, of bad loans by bad loans, defaulted loans, by properly pricing loans, and by pricing interest rates. right? We don't go down to the bank and say, I want to take out a loan, and then they just go, okay, 6% for everybody. What they'll say is something like this. You know, we'll start with this benchmark interest rate. And then if we think that loans of this nature have a 1% greater likelihood of going bad, we're going to add 1% to the interest rate to that benchmark that we started off with. If we think another category of loans has a 3% likelihood of going bad, that would mean that a 3% likelihood, if we made 100 of these loans in this other category, 3 of them would go bad. And so what we're going to do is we're going to charge an extra 3% on all the loans in this category. And that way, the ones that don't go bad will collect enough extra interest to defray the cost of the ones that do go bad. And so what they need to do is calculate the likelihood. Even after they've taken steps against adverse selection, after they've taken steps against moral hazard, there's still a probability, a possibility that loans go bad. And then what they want to do is say, what's the probability? 1%, 2%, 3%, 4%, and of course there can be 0.5%. And so very often what we'll see with business loans, not so much personal loans, but business loans, it'll start off with something called the prime rate. That's the prime interest rate. And that is this benchmark interest rate. And then what they'll do is they'll price loans, prime rate plus 1%, prime rate plus 2%, plus 3%, as the loans get riskier and riskier. And there can be some that are prime plus 0%, that is to say a prime rate loan. That would be for a safe loan. That we just say there's virtually no chance this will not be repaid. And so what the banker wants to do, as I say, even with the risk that still exists, is to price that loan properly. Can I do that? Can you do that? No. My skill is talking about that, but I have never actually done it. Somebody who's made 100 or 1,000 loans, they can properly price these loans. Okay. So anyway, this is how bankers deal with the lending problems that they have, how they avoid these risks. I want to talk about very quickly 2 other things that banks do. Remember, even though we've been talking about asymmetric information, our bigger topic is this. We want to know, why do banks exist? And in addition to dealing with adverse selection, let's say here's reason number 2 that banks exist. The first one was adverse selection, AS. And the second one is lowering transaction cost. Let's say you've got life savings, $200,000, and you were out there trying to lend your own money. Now you can make one loan of $200,000, but then there's no diversification. You're just taking a vast amount of risk. If you've got $200,000, what you'd ideally like to do is make 100 loans of $2,000 apiece. And that way, if a few of them go bad, you still have most of your savings intact. The only thing is, there's high transaction costs of doing that. 1,000 loans? Wow. Right? We're going to be out here and interview 1,000 people. There's very high transaction cost of doing it. And also, it may be that in order to minimize your risk, you say, I don't want to just make loans in this town. I'd like to make loans throughout the United States. I'd like to make some international loans. I'd like to diversify my risk. The cost of actually making loans on such a vast scale required for diversification, very high. And you would eat up all the interest you would get on the loan just in these transactions costs. Borrowers might say, hey, I don't want to borrow the money at the bank. I can issue a stock. I can issue a bond. Yes, but the transaction cost of doing that is very high. You can't just issue stock by going to a copy machine, putting a pretty picture on there, and then running off a few copies and that's it. That's not how we do that. We have to hire experts, and they charge thousands of dollars. And so if you're trying to borrow $100,000 and somebody charges you $5,000 or $10,000 to do this stuff for you, oh my gosh, that's a very high rate. And so bankers are basically handling this kind of stuff, gathering money up and handing it out on a vast scale, and then the cost per loan you get or the cost per deposit you make is very small. And that keeps the transactions cost down. Okay. And so this is the other main function of banks. What we will do next time is actually go on and talk about banking. Okay? And this is our reason that banks exist. I'll see you next time. So long.